Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right. Welcome, everyone. You are listening to Your Money Momentum. My name is Tom Kennedy, and I have Kevin Curley here. Kevin, what's going on?
Getting ready for Halloween. What's your costume this year, Tom?
I don't do Halloween. That's amateur night when you don't have kids.
Well, I have 3 of them, so I'll be dressing up. I'm not sure what yet, but maybe something Star Wars. Who knows? Last year I was Wario, which was a pretty good time.
What do you think the big costume is going to be this year? Ken and Barbie?
The funniest one I've seen is the guy from Creed at the Cowboys halftime show. I've seen that one going around. I think that'd be funny if I see that.
When is Halloween? It's on a Tuesday. So
next Tuesday, yeah.
What's like how do people know when to go trick or treating? Is it typically like Saturday before? No, but do you trick or treat?
No, you go actual day.
Yeah,
you go on Tuesday, and as soon as it gets dark out, that's go time. So dusk, mosquitoes are gone, time to go.
So do parents go with the kids? I mean, it's not
depends on the age. For my kids, yeah. Maybe a few years from now, not so much, and then they just stop completely and they go cause havoc. So it's it's an adventure.
Well, enjoy. My lights will be off in my house and door will be locked.
That's not the friendliest way to go. You can at least hand out apples and be a real Scrooge. So,
all right, let's jump into it. So, mid-month podcast, we will do our topics on something or nothing. We'll jump into some mailbag questions, and then we'll finish with 5 good minutes. And the topic, although boring, important, will be on Medicare.
It's open enrollment time. Get excited about Medicare open
enrollment. And for those of you that aren't even close to Medicare, it's still good to know you might have parents, loved ones that are at that age, and there's some good tips we'll touch on. So let's jump into something or nothing. Kevin, I'll throw the first one to you. Ireland's rise in SUVs, coupled with the health and wealth of the economy, the sovereign wealth fund heading to $100 billion. What are your thoughts?
I think this is something. Ireland was the Celtic Tiger 20 years ago. It really took a tough time for the last I'll call it decade or so, from the great financial crisis till about now. And now we're seeing the rise in SUVs, just kind of a marker of wealth as far as the income of the country goes. So you see a lot more of those. They tend to be a lot more expensive than sedans or some of the smaller cars. And on top of that, they call it a bumper tax season of a windfall as far as credits coming from Google and some of the pharmaceutical companies and other ones that are based over there. They're paying a lot in corporate taxes, and they're thinking about starting a sovereign wealth fund. It's predicted that a handful of years from now, that could be over $100 billion. Ireland's on the rise, and I think this is something as the only English-speaking nation in the EU. How about you?
Yeah.
Let's say you, Tom. Kennedy and a Curley talking about Ireland.
Yeah, exactly. I'm indifferent on it. It's hard. I've never seen a comparison between SUVs and the wealth of an economy, but I mean, 2/3 of every car purchased over in Ireland is an SUV, almost 70%, which is kind of crazy.
The roads are tiny.
The roads are tiny, but the sovereign wealth fund, so they have a target to get to $100 billion over the next 10 years, and they're assuming a 4% rate of return, which I think is pretty modest, and they plan on investing 0.8% of their nominal GDP into this fund. So I think that's something. The SUV sales might just be a coincidence, but I do think it is something with what that country's doing and what it looks like over the next 10 years.
Yeah, the most interesting part about it is learning from their mistakes. So back in the Celtic Tiger days, the leadership goes, "We have extra money. What should we do with it?" And they all said, "We should spend it." And this time around, they go, maybe a rainy day fund, maybe a sovereign wealth fund. Maybe we should keep some of this just in case things don't look so good 5 years from now or 10 years from now.
Well,
Learn
I
from your
heard
mistakes,
that
Tom.
you could declare citizenship to Ireland if you can go back, I think up to 3 generations, which I can't, unfortunately. But
It's a
I'll tell you,
grandparent clause.
I,
You have to have a grandparent who was a citizen. And then,
I wish the U.S.
unfortunately, for
would learn
those
from
of
it.
us who've been here for a while, it's not available anymore.
Yeah, it's unfortunate. We're stuck here in the U.S. That's another conversation.
Hard knock life. All right, next topic, Tom. We've got a 23-year high in mortgage rates. They hit 7.57% on the 30-year fixed. The prior peak was 8.5%, which we hit in December of 2000. Are these skyrocketing rates something or nothing? And will we break 8.5% in this cycle?
Yeah, this is something. I'm gonna spend a couple minutes on this and throw out some stats on just the housing and interest rates. To your point, um, we haven't seen rates this high in over 20 years. To answer your question, I do think we get to the 8.5. I think we go past it. And if you look at mortgage applications, we've had the highest drop in mortgage applications since May of 1995. Right now, it is 52% more expensive to buy a home than to rent one. So, you see rent is high. It's twice as more expensive to actually own a home. And if you look at who's buying homes, one, anyone under 35, I just saw a stat online, which I thought was really interesting. I think it was a Redfin. If home buyers under 35 years of age, 23% of them used cash from a gift from a family member or inheritance money for a down payment. 40% of buyers under 30 received family money for a down payment. So, the younger generation doesn't have the money for these down payments, and they're getting it from their family members. And if you look
Yeah,
at
those high rates hurt.
they hurt. I mean, you need to make $115,000 more to afford the medium home sale price of a home right now versus what it was a year ago. And this is just because of the increase in rates. I mean, they've doubled. So it's, we threw out that stat a couple months ago with, either rates go down, prices go down, or a combination. But right now it's just extremely unaffordable for the housing market. But the challenge is that there's not a lot of supply out there because no one's moving because they're not going to get out of their 3% mortgage to get into a 7.5 or 8% mortgage. So I think it's something. I think it's going to eventually have. This is not sustainable. So the question becomes, what comes down first, interest rates or housing prices? And I think it's going to be housing prices. I don't think rates are going to come down quick enough, and eventually you're going to have to see the housing market come down. I don't think there's going to be a crash, but I think it will come down.
Yeah, I think one big difference from like the '06 to '08 period is I don't think we have a ton of people in adjustable rate mortgages like we did before. And we're going to find out if those reforms for, no doc loans went away, if that mattered. And if people can't refinance and they were anticipating being able to do that, this is going to be a tough time. And like you said, new buyers, they're not going to exist at 8.5% rates. So one thing I think that we didn't talk about was the fact that quantitative easing, one of the things they did at the Federal Reserve was buy mortgage-backed securities. It artificially kept rates lower than what they were. So those with 2 and 3% mortgage rates, great for them, but it might be a situation where the natural rate of interest goes back down to 4 or 5 for a mortgage, and 7, 8 is still considered high, but the amortization schedule on these is really ugly. A lot of these you never end up paying more in principal uh, than interest. It just stays interest forever. It never crosses that line, as opposed to when it's 2 and 3%, 8, 10, 15 years into the mortgage, suddenly you're paying more principal than you are interest. So high rates hurt, and I think it's a long-term problem.
Well, I think to your point, I agree. A lot of these aren't adjustable rates, so you're fine there. You're not going to have this 2008 crisis all over again. But I think the difference is, and I've had some pushback where, you look at 25 years ago, people are, that bought houses in the 80s are like, this is nothing. We had much higher interest rates back then, but the
Yeah, but
difference
they were
was
falling.
well, not only that, but the difference was that the housing pricing was not even close to where it's at. You've had zero
Right.
interest rates and cheap money for over 10 years that housing has gone through the roof. And that's the big difference this time around is housing is just way, way too expensive. The actual price of a house and now where interest rates are, something's got to give. And it could be a combination where you see a drop in both rates and the housing market. But mortgage applications have fallen through the floor. Another quick stat too. I think was it September? Bear with me a second. Uh, number of homeowners hit foreclosure notices in the third quarter jumped 34% from a year ago, up to 125,000. So, I think you're
Seeing a
starting to
similar
see.
thing in autos too.
Yep, similar thing in autos. Just last month, you had 25% of offers fall through. Didn't go to contract. So I think it's starting to hit a little bit, but time will tell.
Yeah, I know. Right in the face of like what was the 4.5% GDP number for the third quarter, and you go, "Oh, the world's falling off a cliff." Well, not yet, but it
Well,
does seem to be trending
GDP
that direction.
GDP was
It's
expected at
backwards looking. Yeah,
yeah,
three and a
it's
half, and it was a
backward.
point higher. It's wild.
Yep.
All right, Tom, we got big news in the oil patch. I'm gonna call it merger mania. Exxon announced they're gonna buy Pioneer. Chevron announced they're gonna buy Hess. There's been a bunch of small caps merge as well, which there's too many to even mention. But what's going on in the oil patch? Is this merger mania something or nothing?
I it's something. It's always something when it comes to oil and gas. But I hesitate because I'm also not shocked either. I mean, one, you have the break even point for profitability has gone way way down than what it was 3 or 4 years ago. I mean, you talk to you hear some of these CEOs speak, and they're saying it's under $40 a barrel for them to break even, depending on where they are in the country. Offshore is a little more expensive, obviously, but you have areas like the Permian and Eagleford, um, the Bakken, which are just much much lower. So technology has been a driver of that. You have the rig count is down. It's actually the rig count has actually dropped 9 months in a row. We're at 750 rigs. You look at 5 years ago, we were double that. So I think consolidation is natural right now. You have technology that's improving, and you also have these oil and gas companies that are just flush with cash. I mean, their end product, um, oil, has gone up drastically, and it's stayed high. I mean, you're at $90 a barrel. We've been there for quite some time, and if your break even is $40 or $50 a barrel, that's a lot of profit margin. And they're taking it back in dividends. They're doing share buybacks, but they're also just flush with cash right now. So when you're flush with cash, why not go out and acquire? And I think it's gonna be a continued trend, and I think it's gonna pick up.
Yeah, I agree. It is kind of something at the moment, but it really feels like nothing in the sense that it's business as usual. I feel
Yeah.
like this story of bringing everything else back on shore and focusing on the Permian and the Bakken and other domestic production instead of going, to the Middle East or to Africa or offshore in order to find oil. That's the real story. Is this 15-year theme of, hey, fracking unlocked all this resource, and we don't have to go to all these dangerous places. We don't have to mess around in scary countries anymore. Let's just do it here. And I think the big players, as you said, are flush with cash, and they can do this kind of thing. Versus, oftentimes, especially in semiconductors, we see the margins are real tight, and as they get tighter, you see those mergers because they go, we can cut some back off expenses, and we can maintain our margins if we merge with another, semiconductor. This is the big players going, we don't know what else to do with our cash. Let's buy more oil. Let's get more energy, and they're focusing on domestic. And yeah, I don't know if we'll like all the bank mergers will end up with just the bank at the end of the street. I wonder if we'll end up with just the Standard Oil Company at the end of the street.
Yeah, I mean,
So
I think, and these are big players too. It's not Exxon
huge, the
buying
biggest
some
one.
small little one. It's Exxon buying, buying
Mhm.
Cheniere. It's it's Chevron and Hess. I mean, these are big players that are coming together. It's a market share grab, just like anything else, and
Mhm.
they're trying to diversify their portfolio from doing everything from upstream, midstream, downstream to gas, natural gas, and I say it all the time, at $33 trillion in debt that this country has, it's going to be very difficult to get out of it, either, inflate, default, or grow. And the way we can grow is by using the resources currently in our own backyards, and it's oil and gas. So
We got a lot.
we got a
But
lot
the youth,
there. So, well, let's move on to the next one. The EU tackles deficits of 80% debt to GDP. The US is at 140% debt to GDP. Is this something or nothing?
oh, this is definitely something. And I'd take it a step further. Joe Biden introduced a bill where maybe we'll see her in role play later. Janet Yellen was interviewed by the Senate, and her just kind of cross examination about that. It was asked about the deficit of $2.7 trillion, which will be the largest deficit and more than double than what it was last year, for over 8% in a time where GDP is at the moment running above 3.5%. So I think this is definitely something. You can't run fiscal deficits in good times at 7, 8% without some major consequences. And you've seen that in the debt to GDP balloon to 140. When you want to compare other kind of OECD countries or the G7 or the G20, and you see especially Europe, which is our best peer comparison, at only 80% debt to GDP and having fiscal deficits of 0 or 2%. They're run like states, not this country. This is a big problem. And I don't know where it plays out in the US dollar or if it plays out in treasuries. I mean, we've seen the treasury rates kind of skyrocket recently, but I think this is a big something that the EU is handling their business and the US is just kind of closing its eyes and they're going to say, we're going to just keep spending. There's no limits to our spending.
It's crazy. I mean, I know we talked about this last time, and the number's probably even higher, but I think we're at 900 billion year to date just in interest carry that we just tacked onto our debt. I mean, as they raise rates, um, the cost of interest is just going higher and higher, and it's just ballooning on 33 trillion and counting. It's just a snowball effect. I agree. I mean, we have to tackle this, and it's Washington is a mess right now, and I am not hopeful. Unfortunately, we'll see what happens, but I agree with you. It's what keeps me up at night is the debt. 100%. We can kick the can down the road just so long until it's gonna come back and bite us big time.
All right, for our last one, we go back to Europe. There is a car called the Microlino that's being rolled out. It is a tiny car, Tom. You know those smart cars you used to see? It's about half the size of that. It looks, I don't know, like a go-kart you're getting into that has walls. It has a max speed of 55 miles an hour. It only has a 143-mile range, and it looks just like the one from the Black Mirror episode with Dallas Howard, where she gets stuck and it stops working and can't get around anywhere. So to me, I wonder the tiny car coming to Europe, the tiny car coming to US, or are these tiny cars going to be something, or is this a big nothing?
First of all, I have never heard of these. I had to Google it right before we jumped on this podcast when I
They're
saw
ridiculous
that.
looking, right?
Just so our listeners can have a visual, it looks like something that Mr. Bean got out of. It's like one of those little tiny cars. I think it's absolutely nothing. I mean, one, it's a death wish. You get hit in that thing, it's gonna crumple up like an accordion. Um, and mean, look, we just said it on the front end of the call. I mean, look at Ireland. To every 70% of their car purchases are SUVs right now. I don't think people are going backwards into these ultra tiny cars. I mean, at that point, at 55 miles an hour, 143-mile range is what you said. You're
Yeah,
better off just getting a scooter,
yeah, or a golf cart.
golf cart, or
Yeah, I
yeah.
guess people might use this as a third car or an additional extra thing to just, oh, I gotta go down the street, maybe something small, but I can't see it replacing somebody's primary vehicle. You can't go fast, you can't go far. I just there's no hope for this little guy.
I mean, I could see a time where a whole city just limited to cars to just this, I'd be more comfortable with
Yeah, that
that.
would make sense.
All it
Yeah.
takes is one of these liberal cities to say, okay, no more gas, no more cars over a certain size. We're all going to go into these Microlinos, and that's how you're going to get around. It's like, an episode of the Jetsons.
Yeah. Maybe like the central business district, they say, hey, can't drive in there unless it's a tiny car. So, all right, where do you want to go next, Tom?
Let's go to mailbag.
It's time to hear from listeners as we open the mailbag and answer your questions.
So I've had a few questions talking to clients as of late about crypto, which hasn't really made headline all that much until recently with the huge jump that we've seen in the last week with the SEC approving new ETFs. Coincidentally, you have Sam Bankman-Fried on trial as we speak right now for the whole FTX collapse. Crypto, or Bitcoin in particular, is up year to date 107%. We actually just went off. Let me stop there. What are your thoughts on crypto? Do you think this is just another blip and it's going to come back down? I don't think it's a fad. I think we can all agree it's here to stay. You have the halvening, what's it called? The halvening event that's coming up, expected early next year. As far as clients go, we can't invest in cryptocurrencies, but just in general, there is a lot of money in the cryptocurrency space. That's just facts. There's a ton of money there. There's a ton of money still going there. There's institutions behind it. It's a risk on asset. So when you start seeing an asset like crypto do well in an environment like we're in right now, what is that saying? And I'll throw out a stat. Prior to this past week when the SEC announced and crypto went vertical, we went on the longest streak in the history of Bitcoin where we didn't see a 10% move in a given day. It's been extremely, how do I say this? It has not been as volatile as it typically has been. And in fact, if you look, I saw an interesting stat the other day. You look from like mid-September to mid-October of this year, the 10 to 20 year bond index was more volatile than Bitcoin. Whoever thought we'd see that, where you have bonds, treasuries, government-backed bonds, more volatile than what we considered one of the most volatile asset classes ever, which was Bitcoin. I thought that was pretty interesting and worth mentioning.
Yeah, I think that the rise in rates, especially long duration, you could end up with 25, 50% losses on some of those bond funds, which is really, really wild. But that's the reality. You take that 1% increase and it happens twice, and suddenly you're down a significant amount on bonds. So I think that phase was something that people got a little bored during COVID, got excited about. I think that AI is where all the VC funding's going. I think robotics is where the VC funding's going. But this year, especially in the spring, April and May, you saw the excitement and the potential of AI. I've been waiting for crypto to show me something for, what is it, 5 years now? How long has Bitcoin been around? It's been a while. Now, AI, I think that has some potential, but I'll wait for Silicon Valley's next trick.
You sound very bitter about it.
I've seen people. It's the same thing with the meme stocks. I've had meetings with clients or prospects, and they, it's almost like shameful. They come up, I got kind of wrapped up in that. How did it go? And they showed up and they're down 99%, 100%. Why did you do this? I thought I was going to make a lot of money. That was it. There was no, I think this company is going to become a bigger company than it is today, or I see some opportunities for them in improving their margins, or hey, they got this merger. There was nothing. It was just, hey, I saw this thing online and I bought it.
No, like I said, I don't disagree with you, but I do think it's interesting. I don't think it's going anywhere. Again, the SEC getting behind it. We'll see. We'll see what happens. Let's jump over to our next question that we've been getting a lot, that we continue to get. I feel like we've been getting for the last 3 years, and it's bonds. I just saw a stat out there on a 60-40 portfolio. Do you know what the return has been over the last 10 years? 2.5%. A traditional 60-40 portfolio has done over the last 10 years.
I know,
and
but it's still appropriate. It's still the right one for a lot of people. I'm not going to let it go.
I agree. We're going on. This will be, if we finish this year where we're at today in bonds, which is down, if you look at the ag, it'll be the third consecutive year of negative performance on the ag, which has never happened before in the history
Yeah.
of bonds. It's been the longest stretch, and again, it has to do with interest rates and how quickly they've gone up. What does this look like going forward? I mean, so you're taking the stance that we need it 60-40 still the way to go. Well, not for everybody, but that's the starting point. We still need
No, I mean
bonds in the
for
portfolio.
a moderate risk investor, I think it's still appropriate. And the hard part has been that, within your 60-40, there's a couple components. So on the 60 side, you got large cap growth, which has been pretty good, large cap value, which has been okay. You have a bunch of small cap, which has been terrible. It hasn't done anything. Now we've had periods of time like this where for 5 years they do nothing, and then the next 5 years it flips and goes the other way. And I think that small caps is a good example of that. But also, if you look at bonds. I read a note from an investment company saying that there's an asymmetrical opportunity in bonds. And what they meant was if you buy the 2 year, the 5 year, the 10-year US Treasury, and over the next year you clip your coupons at 5%, that's a pretty good return. Well, if interest rates go down 1% over the next year, you're going to kind of double that. And that's a really great return, especially in bonds. Now, the flip side is what if interest rates still keep going? Let's say they go up another 1% over the next year. Well, you just break even. So they'd have to go up 2% from here to keep going. And that would put us, as far as the US goes for treasuries, in some really bad company. And maybe that debt to GDP thing that we talked about earlier is a problem and it becomes a basket case. But outside of some major spike in interest rates, you make five. I mean, Muni's tax equivalent, you're looking at over 7% over the next 5 years. That's a really attractive entry point. So you've had the pain. Now let's not give up. Let's stick with the payoff. I think the 60-40 will still work. Bonds have just had a tough time. We haven't had, like you said, bond bear market for 3 years like this. Never happened. I mean, if you look at October of last year, what was the big thing? Hey, buy bonds. The interest rate rise is over. And it's been a terrible move. So I think a lot of people were early, got burned, but I would stick with it.
No, I agree. And it's not rising rates. People, I think this is a misconception. Rising rates is not bad for bonds. It's the velocity that they go up. So when you get these big jumps, it's there's nowhere to hide. And the reverse is true too. Look at the taper tantrum going back to 2013. The last quarter of 2013, the 10-year went from 2.5% to 3% within 3 months. Bonds got hit. Everyone was calling for higher rates. That's it. Then rates dropped in 2014, and the best investment you could have made in 2014 was TLT or the long dated Treasury, which was up 25% in 2014, an annual return for bonds. So as quickly as they can go up, they can come down. But I agree with you. I think we're already there. We're already at higher rates. The pain has already been felt. Now you can get rewarded by getting your 5-6% almost risk free on the yield.
Mm-hmm.
And as long as we don't go up from, the 10-year doesn't go from 5% to 10, I think we're going to be in good shape. I mean, you got to remember we were at almost 0 2 years ago. We were at 50 basis points, and now we're at almost 5. So again, as long as it doesn't double from here. Even if it goes up a little bit, I think it's going to be a lot slower this time. I don't see how it can continue to go up that much more before it becomes really, really attractive to a lot. I think now might be the time. So I agree with you. I think bonds are still there. It's been tough because it's been a tough going on 3 years where we've had negative returns. And looking over the long term, it's really it's really hurt the performance. But I think.
Well, that and we have the magazine test, right? So the Wall Street Journal had an article about the 60-40. They even called it this trusted 60-40 investing strategy just had its worst year in generations. That's typically a time to buy.
It is.
You want to go when there's trouble. And so with the Wall Street Journal, all we need is the economist cover saying bonds are dead or bonds are over. And man, I'll pile it all in, right?
I mean, listen, I think if you can barbell your portfolio with just straight up crypto and TLT, you're going to do really, really well. That's just a joke. Don't do that. We don't recommend it. We don't make recommendations on this podcast. But we'll end with this, Kevin. We are a long way away from the S&P 5000 year end. That was your bold call. That's like
we're only 800 points away. Hold on. What are we talking about? Well, Tom, the best thing that I can say about that is there's this little guy, he's not that little. There's a man in a red suit who comes at the end of every year, if you're good, and he'll either leave you coal or some great gift. So I'm going to hang my hat on the Santa Claus rally, and I'm not going to give up. I mean, got 2 months and 5 days left to go. Why give up now? I think 800 points in 2 months, easy. Let's see it.
We'll end it. We'll leave it there, and we'll pick up our end of the month podcast next week, and we'll talk about the Santa Claus rally end of the year and go over some stats, and we'll make our predictions.
All right, great. And look out for our Medicare open enrollment video, which will be published relatively soon.
All right, thanks, Kevin.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets. This podcast is intended strictly for educational purposes only and is not a recommendation for or against cryptocurrency.